We are going to get to study some exciting things in this chapter, like saving for retirement or calculating the house payment on your dream home or the car payment on your dream car. But Section 8.2 deals with income tax. Not that exciting of a topic, but definitely necessary. A lot of our calculations in this section will be dependent on your ability to calculate a basic percent of a number. But as you have probably experienced in reality, taxes can get very quickly complicated. So I hope this section helps you to sort through the terminology and gives you the ability to manage your taxes well. In Section 8.2.1, we're going to focus on the idea of calculating taxable income. Before we can determine how much income tax we owe, we have to figure out what portion of our income is taxable. So, income tax is a portion of a citizen's income collected by the government to fund its services and programs. To determine how much income tax a citizen owes, first we have to figure out taxable income. Now, our taxes are used for good purposes, such as maintaining the roads that we drive on, or even taking care of our state and national parks. And the tax that we owe is a portion of our income. But what income is charged? So let's talk about all of the terminology associated with calculating taxable income. The first word that you need to be familiar with is gross income. A citizen's gross income is their total income for the year. And this is not necessarily just from your job, it can come from other sources as well. So this includes your wages, tips, salary, dividends from investment, unemployment compensations, profits from a business, rental income, or even game show winnings. If you win big on a game show, you're still going to have to pay taxes on it. The next thing you want to be familiar with is adjustments. Adjustments are untaxed portions of a citizen's income, such as contributions to retirement accounts, which we're going to learn how to do soon, or tax-deferred savings plan, interest paid to student loans, or alimony payments. So if you take a portion of your income and you dedicate it to a retirement account, you are not going to be taxed on that portion of your income. It is a benefit to saving for the future. So your gross income is all the money that you bring in for the year. Adjustments, we're going to deduct your gross income a little bit by subtracting how much you contribute to a retirement account, tax-deferred saving plan, etc. A tax-deferred savings plan simply means that that amount of your income is not going to be taxed. Okay, I hope this terminology becomes simpler as we go. Number 3, exemptions. An exemption is a fixed amount set by the IRS for individuals and their dependents used to reduce taxable income. So once you determine your gross income and you subtract your adjustments, then we're going to subtract these allowable amounts by the IRS, and it decreases your taxable income a little bit and reduces the amount of tax that you pay. Similar to that are deductions. Citizens may take a deduction based on their taxable income, taking the larger of the following. A standard deduction is a lump sum amount that you can subtract from your adjusted gross income as set by the IRS. In the same way that your exemptions are set by the IRS, the standard deduction is also set by the IRS, and those can change year to year. Now, on the other hand, itemized deductions are individual deductions, such as interest on home mortgages, state income taxes, property taxes, charitable contributions, and medical expenses. So you are allowed to take the larger of those two. So the IRS is going to set this standard deduction, but if your expenses, if your charitable contributions, if that exceeds that standard deduction, we're going to subtract that number because it has the power to bring your taxable income down and allow you to pay less tax. Okay, let's put it all together. To calculate our taxable income, first, we're going to start with our adjusted gross income, AGI. This is our gross income, the total amount that we make for the year, minus our adjustments. Now, remember, our adjustments are the things that we dedicate to savings, such as retirement or something like that, okay? So those bring our gross income down a bit and reduce the amount of tax we have to pay. Then our taxable income is going to be this number, adjusted gross income, minus the exemptions as set by the government and deductions, either the one set by the government or if your itemized deductions exceed that standard deduction, it will bring your taxable income down a bit. So the amount of income that you are taxed on is not the entire amount that you bring in, your gross income. Your taxable income is your gross income minus the adjustments, exemptions, and deductions. What's left is what you are charged tax on. Now, I know that's quite a bit to take in, so let's pause for a minute before we calculate income tax and just make sure that we can calculate this taxable income amount. For example, a single man earned wages of $46,500. Let's highlight the important information as we go. Received $1,850 in interest from a savings account. He received $15,000 in winnings on a TV game show. Awesome. Wheel of Fortune or something like that. And he contributed $2,300 to a tax-deferred savings plan. He is entitled to a personal exemption of $3,800. Remember, that's set by the government, and a standard deduction of $5,950. The interest on his home mortgage was $6,500. He paid $2,100 in property taxes, $1,855 in state taxes, and he contributed $3,000 to charity. Calculate the following. Okay, first thing we want to do is calculate his gross income. His gross income is going to be the sum of the income from all different sources for the year. So he has wages of $46,500, that's income. $1,850 in interest from a savings account. Notice that is interest that he is earning, not paying. On a savings account, he is earning interest, so that's part of his income. He received $15,000 in winnings on a TV game show. So all of those comprise his gross income. So his gross income is going to be the sum of $46,500 plus $1,850 plus $15,000. All right, I'm just going to add that up on my calculator. $46,500 plus $1,850 plus $15,000. So his gross income for the year was $63,350. I think the game show helped him out quite a bit. Now, the next thing we're going to calculate is his adjusted gross income. This is going to be his gross income minus adjustments. Now, remember, adjustments are values dedicated to retirement, tax-deferred savings plan, so on and so forth. So notice he gave $2,300 to a tax-deferred savings plan, and then everything else has to do with exemptions and deductions. So to calculate his adjusted gross income, we're going to take the $63,350 and subtract $2,300 in adjustments. Maybe he's saving for retirement. So $63,350 minus $2,300. His adjusted gross income is therefore $61,050. $61,050. With that value known, we are ready to calculate his taxable income. Now remember, his taxable income is going to be his adjusted gross income minus his exemptions as set by the government and deductions. And we're going to figure out which deduction is most beneficial for him. So remember, his AGI was $61,050. Let's see if we can find exemptions in the problem. Here it says he has a personal exemption of $3,800. And again, that value is set by the government. Next, he has a standard deduction of $5,950. That's an amount set by the government. But also notice he paid mortgage interest of $6,500. He paid $2,100 in property taxes, $1,855 in state taxes, and he donated $3,000 to charity. Now, I can't deduct both the standard deduction and these itemized deductions. I'll call those ID. I have to figure out which one is greater. Okay, so the standard deduction is $5,950. Let's sum up all of his itemized deductions and see if it exceeds that $5,950. So over here, I'm going to do a little bit of side work. Let's figure out the itemized deductions. So we're going to add up, now excluding the standard deduction, we're going to look at his home mortgage interest of $6,500, $2,100 in property taxes, $1,855 in state taxes, and $3,000 to charity. Let's add those together. All right, so we're going to add $6,500 plus $2,100 plus $1,855 and $3,000. So his itemized deductions total $13,455. If we compare that to the standard deduction, the standard deduction was $5,950. That's given to everybody regardless of their situation. But in this particular man's situation, this one exceeds the standard deduction. So we're going to subtract his itemized deductions as opposed to the standard deduction because of his behavior, because of his financial behavior, his itemized deductions will serve to further decrease his taxable income and reduce the amount of tax that he has to pay, which is good news for him. All right, so let's put it all together. We have our adjusted gross income, $61,050, minus his exemption, $3,800, minus his itemized deductions, $13,455. So the amount that he's actually going to pay tax on is $43,795. $43,795. Okay, so notice his gross income for the year was above $63,000, but he's only going to be paying taxes on a little over $43,000 of it. So the calculations are very simple. We're adding and subtracting. What makes this complicated is just keeping everything straight with all the terminology and vocabulary. Let's practice that one more time to make sure we have all of this terminology straight. Example 2. A taxpayer earned wages of $52,600, received $720 in interest from a savings account, contributed $3,200 to a tax-deferred retirement plan. He was entitled to a personal exemption of $3,800 and had deductions totaling $7,250. Calculate the following. We'll begin with his gross income. His gross income is the sum of all sources of income. First of all, he had wages of $52,600, and he earned $720 on his savings account. And everything else is deductions, adjustments, and exemptions. So let's add those together to get his gross income. $52,600 plus his $720 from his savings account, $53,320. So his total income for the year is $53,320. Next, let's calculate his adjusted gross income. Remember, his adjusted gross income is his gross income minus adjustments. That's pretty easy to remember. What's hard to remember is what was the adjustment. The adjustment is how much he contributes to tax-deferred retirement or other savings plans. So we're going to take his gross income, $53,320, and we're going to subtract the $3,200 that he put away for retirement. He's not going to get charged tax on that $3,200 that he's saving for retirement. So let's type that in. $53,320 minus $3,200. So his adjusted gross income then is $50,120. So this man is doing well. He has a savings account and he has a retirement account. Though that is good financial planning, and we're going to talk about details for both of those aspects in later sections. Let's go ahead and calculate his taxable income. So his taxable income, remember, is his adjusted gross income that we just calculated minus exemptions set by the government, which may change from year to year, and deductions also set by the government, which may change from year to year, but remember we have the option of itemized deductions. So he was entitled to a personal exemption of $3,800, and he had deductions totaling $7,250. Now remember up here, following this as our guide, the standard deduction was $5,950. His itemized deductions exceeded that, so we're going to take the higher of the two. So here we go. His adjusted gross income, $50,120, minus his exemptions of $3,800, and his itemized deductions. We're not told about the details, but remember that could be things such as contributing to charity, interest on your home mortgage, property taxes, etc. Okay, so let's calculate his taxable income. $50,120 adjusted gross income minus $3,800 in exemptions minus $7,250 of deductions. So his taxable income is $39,070. So he earned a total of a little more than $53,000, but notice he's only going to pay taxes on about $39,000. Okay, I know taxes are not a lot of fun, but I do hope that this helps you sort through all of the details and you'll be better prepared to plan for and calculate your income taxes next time around. In the next section, once we know taxable income, we'll actually be able to determine how much tax an individual owes.